Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Tuesday, March 24th, 2026, and this was a quiet bleed with a very loud message. The mood wasn't panic, it was cautious. Money didn't rush out of stocks, it just moved around inside the market, and the dominant theme? Mega cap growth suddenly stopped carrying the tape, while energy and defensive pockets kept catching steady bids. Now crack the hood. The S&P 500 Heatmap told a really split story. A lot of mid-sized boxes were green across energy, industrials, utilities, and parts of financials and staples, but several index-heavy megacaps lit up bright red and dragged the surface. Communication services was the glaring weak spot, led by Google with Meta and Netflix, also heavy, and large-cap software pressure showed up through Microsoft. That's the masking effect in real time. The board looks healthier than the cap-weighted index feels. That heat map split? That was the rotation in action. Capital rotated away from the most crowded index-concentrated growth exposures and into groups that look cash-flowing, inflation-resilient, or defensive energy. Led as that oil risk hedge bid stayed in the tape. Industrials joined in as the market leaned into tangible cyclicals, and utilities and staples catching bids added a risk-off flavor inside equities without a full exit from stocks. So here's the tension the market showed today. On one side, you've got a repricing of the mega-cap growth complex, where valuation, capex anxiety, and rate sensitivity matter. On the other side, a tape that still wants real economy and inflation hedge exposures. It didn't resolve today. It just showed up as a clean leadership change. Breadth looked comforting, but the generals looked threatening, and that's what kept the session tense, even without capitulation. On the chatter side, the desk focus wasn't one headline, it was positioning stories. Traders kept circling back to AI capex and free cash flow sensitivity as reasons the mega-cap platforms and software were being de-risked. There was also leadership break talk. When the biggest boxes are red, behavior changes fast, and separately, people kept pointing to a persistent geopolitical risk premium as the backdrop for that energy bid. None of this is a clean single catalyst explanation. It's narrative framing that can amplify moves on a rotation day. Right now, markets are caught in a violent tug-of-war between headlines and reality. We started the week with a glimmer of hope after President Trump hinted at a breakthrough in negotiations, even postponing planned strikes on Iranian infrastructure for 5 days. But that optimism hit a wall this morning. Tehran's parliamentary speaker called those claims, quote, fake news, aimed at manipulating the indexes, and said there are no direct talks. The result, Monday's so-called relief rally has vanished. Brent crude is ripping back above $103 a barrel, as traders realize the geopolitical risk premium isn't going anywhere. We're seeing a big disconnect between Washington's narrative and what's happening on the ground, leaving investors stuck in a wait-and-see pattern that's punishing the bulls today. The real story today isn't just the rhetoric, it's the logistics. The Strait of Hormuz is effectively locked down, and we're now feeling the full weight of roughly 13 million barrels a day of missing global supply. This isn't a local conflict anymore, it's a global energy crunch. Overnight, drone strikes hit power plants in Bahrain and Kuwait, triggering widespread outages and signaling a wider combat zone. In response, the Pentagon is deploying over 1,000 troops from the 82nd Airborne to secure regional interests. For traders, this is the worst-case mix, escalating military presence with almost no energy flow. Look at the bond market, the 10-year yield is jumping toward 4.4%. The Fed's in a corner now because war-driven inflation makes a rate hike look more like a certainty than just a risk. Google was one of the loudest signals in the session, down just under 4%, and it mattered because it's a huge index-weight box. With the rest of the board looking mixed to okay, that bright red Google tile screamed leadership break and pushed the rotation vibe even harder. And this wasn't a one-off print, it lined up with broader communication services weakness. Microsoft slid just under 3%, and the market treats that as way more than just one stock. It's a bellwether for large-cap software and the AI platform trade. The framing today was pressure tied to AI capex and profitability worries, plus multiple compression in rate-sensitive megacaps. With that kind of weight, Microsoft weakness acts like an anchor on tech-heavy benchmarks. Exxon EXOM sat on the other side of the tape, up about 2.5%, acting like an anchor bid for energy. The backdrop was an inflation and geopolitical hedge posture tied to crude sensitivity, and visually, when EXOM is bright green while megacap growth bleeds red, it screams rotation, not a market-wide dash to cash. Caterpillar CAT popped just over 2%, and it was a clean tell on a day when the Nasdaq was on the back foot. The action fit the rotation story. Industrials catching bids as investors leaned into tangible cyclicals instead of long-duration growth. When CAT is strong in this kind of tape, it reads like portfolios getting rebalanced into the industrial complex. Walmart WMT gained just over 1%, and that matters because staples don't usually lead on pure risk on days. The read was simple: a defensive ballast while growth sold off. WMT in the green is part of the confirmation that today was about de-risking factor exposure, less duration and beta, more stability, and cash flow certainty. NVDA slipped only about 0.25%, and that relative stability stood out given the broader growth de-risking. The takeaway? Semis weren't the main problem today. The real pressure was in the big platforms, large-cap software and communication services, that keeps NVIDIA in the check-the-pulse bucket for the AI complex, not the epicenter of today's selling. Looking ahead, the near-term tells are still the leadership stocks. Watch whether Google and Microsoft stabilize or see follow-through selling, because that's what pins or frees the cap-weighted indexes. On the other side, watch whether energy leadership, through names like EXOM, keeps going or rolls over. And keep NVIDIA on the screen as a relative strength check on the AI complex. On the calendar, attention shifts to end-of-week labor and ISM catalysts. Jolts and consumer confidence hit on Tuesday. ADP plus retail sales and ISM manufacturing on Wednesday. Claims on Thursday, then the jobs report and ISM services on Friday. To wrap it, the market didn't capitulate. It rotated. Participation was better than the index headline suggested, but concentration cut both ways because the biggest growth names still set the tone. Energy and defensives held the line, while communication services and large-cap software carried the downside weight. Going into the next session, keep it simple, watch the generals. If they stabilize, the tape can calm down fast. If they keep bleeding, that masking effect can disappear in a hurry. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.